Please, speak as you might to a young child or a golden retriever. It wasn't brains that got me here, I can assure you of that.
Saturday morning, once again, and welcome back for another weekly market recap at the end of another volatile week, and what a few people are already starting to call the beginning of World War III. I don't know, quite honestly. Just a tiny bit of disclaimer. I will try as much as I can to not talk about the war, not because I don't think it's important, especially for markets. We already seen what's going on in the energy markets, and I think especially my region, Europe, will be particularly hit. But, I think it would be disingenuous. I don't know, and I think you don't know either, right? All I know is that you never fight the wars you plan for, in the sense that things can change. New things can unfold themselves. The quote unquote enemy could react in a way you didn't expect. So, I think it's pointless to try to make predictions about what's going to happen. And plus, I don't want to get into the, moral or political debate. Is the war fair? Is it wrong? Was it a mistake? I don't know. I mean, I can have my opinion, but I don't think it's going to be impactful for what the talks about markets will be. So I'm just going to skip it, and I just think be prepared for anything, and you're going to be set, right? Which I know it's not a great help, but hey, it's all about managing risk, right? So every risk you can assess or think about in your personal life, which could be impacted by what's going to happen with this war, with energy costs and whatnot, just try to hedge yourself for that in the best way you can. And, other than that, you are not really in control of the events. So all you can do is to react. So that's it. Now, apart from that, let's have a look at what came in from the economic calendar standpoint, because this week, although all the focus was on Iran, right? But we had a good chunk of economic data coming in. Now, starting out with ISM manufacturing PMI, which came in positively, 52.4. It's the second monthly expansion, as you can see. And, again, might be the time where you see manufacturing actually taking off in the US. I don't know. And, if you look at the manufacturing employment, there was a little bit of a tiny uptick in that too, right? Plus, again, services PMI, they keep on being on an upward trajectory. So it looks like, all things considered, no matter the recent energy shock, no matter the fears about inflation being reignited, considering what's going on in the Middle East and with oil, it looks like the economic data, at least for this sector, among all the economic data which you could look at, well, they came in pretty good, right, in the grand scheme of things. Now, my interpretation is a little bit mixed up. Like, initially I thought, that is strange, right? I mean, why now? Might be because at the end of the day, tariffs are actually taking place. They are producing an effect. All right, maybe. Or could this be that someone is kind of front running the events in the Middle East and, purchasing a lot of things they need now because they do think they going to be more expensive into the future? And then I thought, well, but, the data, it was for January and February. So, I mean, that would be like saying that there were insiders which knew 2 months in advance that a war would have come, which I'm not saying it's not possible, but it looks, I don't know, it looks a bit stretched, right? So, regardless of the cause, right? The problem for me would be, okay, so they are purchasing a lot of stuff, right? Which, by the simple definition of these indices, right, it should mean that economically we are seeing activity, which should be good, all right? But then I look, let's say, at ADP employment change, which it's not really screaming joy for the labor market, right? Then I look at the initial jobless claims, which, still stagnant, not a lot. So, even if you look at the continuing jobless claims, they're ticking down a notch, but pretty much they are in the same place they have been since the end of 2024. But what I don't like is looking at retail sales coming in negatively on a nominal base, right? So, if you adjust for inflation, they are even more negative. And I just think, look, the producing side of the economy and the service side of the economy, they are showing up activity. But, on the other side, right, of the economic machine, the consumers are not really catching up. So all these purchases, right, it could be raw materials, it could be whatever, items, objects, whatever, right? Who are you going to sell them to if the consumer side of the economy is really struggling now? So could this be another, over-optimistic type of dynamic? And then, you predict a huge deal of economic activity, and then you find out that, well, we loaded up on inventories or new materials to be processed, and then, in order to sell out the finished product, but then we find out that there is nobody there to buy it. So that would be the risk. I'm not talking about certainties, but I'm talking about the risk, right? Oh, so, I'm a bit skeptical yet. And then I look at NFP coming in negative, minus 92K. And there were revisions for the prior 2 months, December and January, which were revised down. And I'm like, okay, so again, if the US economy is 68, 70% consumption driven, who's gonna support, if you want to assume there is activity on the producer side, but who's going to support that? At the end of the day, if you think, where do revenues come from? Consumers, right? So if they start to have less jobs, less wages, less purchasing power, what's going to happen? So, I think still too early in order to call for an economic renaissance. Plus, it's not like, the economy, it's most likely slowing down, but it's not tanking yet, although it's weakening, so to speak. It's softening, so to speak, right? Then what do we got? Unemployment rate, which ticked up 10 basis points, but still around these highs, 4.4, 4.3. We have been in here since September 2025. So the good thing is that it's not keep on going higher. Yeah, sure. But, is it an elevated level above 4? I mean, in absolute terms, it doesn't sound like a very, very bad place to be at. The point is that, as I said many times in the past, I don't think the headline unemployment rate captures all the people which are not working. And we have been talking about the difference in between U3, U6, adjusting for the labor market participation rate and all the rest. So I'm not going to get over it once again. But, you get the gist of it. I think there is more to this story right here, right? So I think still you should be a little bit skeptical about the resiliency of the economy and, especially the projections to keep on being a red hot economy, a booming economy. I don't think it's really reflected in the data. I do think on the other side, there are a few things which could keep on sustaining it up until the point they last, like, the AI build out, big tech mega companies, CapEx, building up that infrastructure will most likely create jobs or sustain wages, at least in those sectors. And in aggregate, it could, give a contribution to make things look better than what they really are beneath the surface. But again, it's another one of those things which might be temporary, right? I mean, once you finished build up all these data centers, what are you going to do with all those workers? Let's say, for instance, it takes 500 people to build up one of these data centers. But then when it's finished, it takes maybe just 30 or 40 to keep it going, to maintain it, to make it operational in the medium to long term. what's going to happen to all the other, 460, right? So, I mean, yeah, just balance out all the side of the equation and try to come up with an answer, right? Now, as for the average hourly earnings, still pretty stagnant in my view, and not a lot to see. If not, that they are not keeping up with inflation. I mean, you may think inflation came back down, sure, but there is still inflation, 2.5%. So over a long enough period of time, if wages don't keep up, you're going to see the effects. Average hourly earnings, they are still trending down. So, wait. So did I misspoke? These were what? Oh, this is kind of the same. I got it twice. I guess one of the two should have been weekly hours. Well, I mean, okay. Can I quickly get it? Maybe not. It should be at the top, right? Average weekly hours. There you go. Pardon me. Looks like I woke up. Not completely, maybe. So weekly hours, all right, definitely trending down. And again, hourly earnings year over year, trending down. So you're working less and you are earning less. Doesn't end up well. So that's where I would leave the entire thing for the economic calendar, and that's where we should transition into the charts. Speaking of charts, we are going to start out with the one and only DXY. So, I mean, is it surprising that DXY had a little bit of a rebound in here, and it got back to these recent highs in here? All right. I mean, the initial scare on Monday, Tuesday, and then it started to go sideways a little bit, which, you might say, well, that's good. If that's all it got, that's kind of good for the overall global economy or monetary system. We don't want to see a huge spike to the upside because that would put a lot of pressure pretty much onto the rest of the world, right? But is it over yet? Or do we have more to keep on pushing higher? I would think, all things considered, you should look at this chart in combination with the others. So, DXY and the other majors, as for the currencies, yields in the US, oil, and maybe precious metals. I'm going to tell you what I mean. Look, if you just look at this chart in isolation, that just looks like, as we were talking about, we failed to break down out of this range right here. We came back in, so, naturally, if we can hold the reclaim, either we mean revert back into the middle of the range or we target the other side. It looks like for now we are kind of in the middle. We came back up above the midpoint of the range, but not yet to the other side of it. Okay, for now, that's good enough, I guess. Conversely, sure, the euro came down, the British pound down, Japanese yen down, Canadian dollar, especially on Friday, up, and the Swiss franc, hanging in there way better than the rest, as we discussed last week. I don't know what's up with the Canadian dollar. I mean, I do know Canada produces and exports a lot of energy, so it might be that if a lot of nations and countries around the world, if they cannot get the energy they used to get from the Middle East, they are, trying to ask someone else, maybe in Canada, and Canada is saying, yeah, I mean, I have a little bit, I can spare a little bit for you, but, if you want to buy it, what am I accepting? Obviously, Canadian dollars. So maybe, people would need to do what? To sell their currency, buy Canadian dollars, and then purchasing energy resources from Canada. It's not really like that. They would most likely buy US dollars in order to transact in, the international banking system. then the Canadians would receive the US dollars and they would dump the US dollars to get back into their own local denomination, but the effect could be the same. So maybe, I don't know, it's the only thing I would come up on the top of my head, just, thinking about it for 2 minutes. Because historically, I don't think that in times of, crisis, you default back to the Canadian dollar. So, that's that's what I would think. Again, very quickly. Maybe there's more. I don't know. Wasn't prepared for this one, right? But what we've seen is that at this point, after the initial drop in currencies and the initial spike in the DXY, they all stopped and started to go into a range. Now you might say, okay, I mean, the euro kind of came back into an old support, all right? The pound, all things considered, if you start to look at this level or this region right here, yeah, pretty much is an old support, right? It was bridged, reclaimed, up we go, and now we are back into it. Okay. Japanese yen, same. You could say, these pick the wrong level. Fucking anchor. This was a level which was, respected in the past, as you can see, or at least an area. We are back into it. Okay. So, I mean, why did they stop falling? I think, even if you look at the rest, like Chinese yuan, South African rand, the ruble, the ruble was already weak last week. India rupee, do you remember? This pattern right here, pump drifting down, was very similar to this one, and the end result was the same, new lows. Brazilian real still, holding this level right here, so not bad. Australian dollar, again, kind of like the Swissy, but sold in there, good enough for now. But I was saying, why it might be that all these currencies, or at least the majority of them, had that initial drop, and then they started to go sideways and to carve out support, right? I think, again, if you start to look at the market, all together, what happened to yields? They spiked a little bit to the upside, right? And, it's even clearer if you look at the bonds. Look at the 2-year, right? They came massively down, all right? So my assessment would be, look, I think it's very likely that given what we've seen with oil, a lot of nations around the globe, they started to do what? What do you do if all of a sudden you fear an energy shock? Well, you would buy oil or gas or whatever energy resource you need pretty much now before it keeps on going higher and higher, which incidentally would add to, would add fuel to the fire, and it would propel the market even higher. But, it's still better to buy today because tomorrow it could be $5, $7, $10 higher than that. So, all right. And what do you need in order to buy nat gas or oil? Well, in the vast majority of the cases, these commodities are priced in dollars. So you need the dollars, right? So what do you do if you don't have the dollars, or if you need way more than what you anticipated? Well, you got your reserves. So you sell the reserves, aka treasuries, you buy the dollars, and then with the dollars, you buy oil and nat gas, right? So I think that's what we're seeing. Plus, again, technically, especially in the medium and long end of the curve, that was a pretty good drop. So the market was particularly overextended to the downside. Let's call it oversold, right? And therefore, bonds, the underlying security was particularly overbought, right? So, a drop like that with a catalyst of what we're seeing in the Middle East and in the energy markets could explain why we had these tiny little spike in yields, right? Which at the end of the day, if you zoom out enough, if you look at a weekly time frame, does it change a lot? I mean, look at this past month, right? In here and in here. Isn't it normal that when you are pretty much extended like in here, you pull back a bit? Like it was in here, right? 1, 2, 3, 4 weeks down. tiny little pullback, all right? Same here, 1, 2, pullback, keeps on going, another pullback, and then a final pullback which rebalances out all this inefficient leg to the downside, and then what? Continuation. And then pullback. So, I mean, I think even in the bond market, there might be a lot of volatility, but I wouldn't judge the long-term trajectory of yields based on these 4 or 5 days of war, right? I'm not saying they couldn't come up or keep on climbing to the upside. Let's say, the case would be, well, if the war keeps on going for another, getting to extremes, 6 months, all right, so to speak. And a lot of countries like Europe, China, or India, they don't have enough dollars to keep on buying oil, which supposedly will keep on going higher and higher. What they're going to do? Well, they're going to sell even more treasuries to get even more dollars to buy even more oil at higher prices. So, yeah, at that point, you might say yields will keep on climbing higher. I don't know how long that process could be, in the sense that how long could it last? Because, it just, we've been looking at the economic data for the US. That don't think that in other parts of the world, those data are actually way better. Like if you think about Europe, if you think about China, if you think about Japan, right? Or Korea, India, but there are a lot of places which are facing the same problems of the US. And, if oil shock hits all of them, what do you think is going to happen to demand? Do you think consumers worldwide are very, well positioned to endure or to support or to withstand oil at, $100, $120 per barrel? No. I mean, I don't think so. I'm looking at Europe, I'm looking at the US, and sometimes I look at China. I don't think they are prepared to support or to endure an energy shock. So yeah, I mean, you might say, well, inflation should skyrocket because oil, it's basically in everything. Yeah, sure, it is in the production process of everything, but, and I get the point that the demand for oil and energy in particular, it's very inelastic, but if I have to spend more in energy, whether it is oil, gas to, fill the tank of my car or to keep the lights up at home, if my electricity bill starts to skyrocket, what am I going to do? I mean, my wage is not going to keep up. So I will have to take my discretionary spending, stop using it for discretionary things, and allocating it all to pay my electricity bill, which in aggregate should be what? Disinflationary, if not deflationary. So I think, at the end of the day, if an oil spike goes ahead for a long, long time, or a long enough time, it might be the straw which breaks the camel back, right? Now, let's have a look at what happened in gold instead, which, to be fair, was interesting, because you would expect, well, I mean, is it a safe haven type of trade? You go back to gold when everything's breaking apart. So we have war in the Middle East erupting. And again, why do we see gold going up on Monday and then Tuesday it was shattered down? Now, first of all, we already had this technical level, right? And you remember, look, this top right here might be an area where we could see a reaction, in this case to the downside, that would be a rejection. If you see a rejection here, there is still this inefficient leg to the upside and this base which wasn't tested. So rejection here, get ready for the possibility that this range is now rebalanced. Took the market 1 day to do that. But at the same time, gotta say, again, the reaction on the opposite side was good as well. So, it looks like at the end of the day, it played out kind of nicely. So the point might be, if you try to picture gold in the grand scheme of things, one might ask, okay, but why didn't gold, quickly go up? I mean, is it a safe haven? Is it the one thing which doesn't have any counterparty risk? So in times of war, and a war which looks like it's escalating quickly, why aren't people piling into gold? Or, for what matters, other precious metals. They all had that same pattern, right? Actually, silver came straight down on Monday instead of having a little bit of a move to the upside. I mean, it opened a bit higher than the close, but then, down. So I think, again, same answer. You need the dollars to buy the energy supplies that you need. You're going to sell everything you got. Gold, silver, treasuries, whatever. It doesn't matter. What you want to have in this moment. And again, it might be temporary. It might be just, on the back of the fear. But the initial reaction, the knee-jerk reaction would be, forget about the long-term shit about gold, or the money debasement. What's the most pressing problem we got now? Well, oil going to 100, 120. So we do need to keep the lights up. Well, okay, so we need to get the oil. How do we do that? Well, it's priced in dollars. Sell everything. I don't fucking care. Sell everything. I need the dollars to buy the oil, because it doesn't really matter what gold is gonna do if I'm gonna be in the dark tomorrow, right? So I think it was some sort of dynamic like that, and therefore you've seen yields going up, currencies plunging down a notch, precious metals having these initial knee-jerk reaction, which again, does it mean that gold had stopped out? I don't know. I mean, at the end of the day, yeah, sure, we made what? For now, it's still another high low. So it doesn't mean that gold topped out. I just think it was, a movement driven by fear and liquidity needs in the very short term. Could this keep on going? Well, again, if oil goes to 120, 150, and the war in Iran goes along for another 6 months, if global trades are impaired, whatever, yeah, maybe people will keep on selling gold because they need the liquidity, which the hard asset, when liquidity dries up and credit is shuttered and global trades are shuttered and money are not flowing throughout the system, the only hard asset, it's US dollars. Because the vast majority of global debt, it's denominated in dollars. So when that debt comes due, you need to roll it over, or God forbid, you need to buy stuff that you need to survival, like energy, right? And the only way you have to acquire it, it's to pay for that in dollars. Dollars, it becomes the only one hard asset, right? Again, now I'm not saying it's going to happen. It depends on what type of developments we will see in the Middle East. But, for now, that's what we've seen in these first week of war. And again, huge caveat, as I said in the beginning, the fog of war currently could hide a lot of things. So, if you are a trader, these are great times to be alive. Although, pay attention to your size, to your stop loss, and manage your risk, because these are markets where you can make a lot of money very quickly, or you can lose a lot of money very quickly, right? If you are a long-term investor, I would say just, don't panic out. Don't go out, sell everything you got just because we got a war, because, give it time. The market, all markets, they need to look through it, right? Don't take decisions on a long-term portfolio which are based on short-term knee-jerk reactions. That would be all I have to say about it, right? Now let's have a look at the elephant in the room, which I left kind of at the back of the queue here. Oil now trading, at least the futures, WTI, they are trading at 91, or they closed at 91. As you can see, they gapped up and they immediately came back down. And all of these, the move down, that happened in the first, I think, 2-3 hours after the open on a Sunday. Let's say, 3 hours basically. Opened, down, 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 up only, right? So, as expected. I mean, if you look at the weekly time frame, look at that. We opened, we immediately tried to gap fill, and up we went. So you know, bullish week for oil. Why not? Right? That was vastly expected. And again, especially because, it was grinding higher way ahead of the war. So again, getting back to the same topic I was kind of hinting at in the beginning, although, very different subjects, but we were talking about insider trading or, people having access to privileged information. Look, for me, it was kind of like I was bearish oil, if you remember. And when did we stop being bearish? In here, more or less, right? Which again, is it the ultimate bottom at 55? No. But look, low, bounce, drifting down, another low, bounce, drifting down. Oh, no new lows. All right. And what do we start to look at? This high, if you remember, it's still there in red, right? Oh, we violated the high. So high, low, high, high. Is it a trend changing right there? And that's basically where we say, well, again, fundamentals for oil might not be the best, but, the charts, it's not lying at the end of the day. And you see that 2 months after, we find ourselves looking at oil at these levels. Now, sure, would never ever gone like that quick if it wasn't for war, but it looks like starting the middle of January, someone started to sniff out something. And especially in here, I think, with oil getting back up so quickly and then staying in this range, they tried to push it down a lot in February, and it was impossible to. And especially getting into the end of the month when we started to see aircraft carriers being moved along through our oceans, that's where really gold started to accelerate to the upside. And, with the catalyst of the news, with the event, that was the final strike to the price of oil, and they just sent it higher. So I think for now, what do you think is going to happen to oil? Well, it's going to impact the entire world, obviously, but maybe a few nations will be able to face the shortages or the price increases better than others. What am I talking about? It's mainly these. For instance, if you check the traffic throughout the Strait of Hormuz, right, what you see is that the majority of that goes to China. A good chunk to India and Japan and South Korea, other Asian countries. And, Europe gets a lot. Although, I guess for us in Europe, it's way more important for the nat gas that we take from Qatar. So, it doesn't look like we would be impacted so much from the oil thing, but nat gas, LNG, that would be a huge pain in the ass for us. And, gas already doubled. If you look at the, quotation on the Amsterdam Exchange, which is basically the European benchmark for nat gas, I think that closed at what, maybe 53. I don't remember on the top of my head, but it was, beginning of the year in January, it was 25. We are already at 53. So, a little bit of a problem for us. Now, I think why maybe, as far as people can tell for now, the US could be a bit shielded from that. Well, it's because over time, they kind of diminished their dependency on, oil coming from the OPEC countries, as you can see in here. They still import, right? Sure, but compared to what was going on in the 90s, well, it's way less. And God forbid, it's way less than what it was in the 70s, which is why, again, I'm not completely sure I do agree with we're getting back to 70s style inflation scare or stagflation. Maybe not to that degree, right? Look, I think the thing might be, look, if oil goes up, it doesn't really matter if you are importing less of that. It's just, it's going to be repriced worldwide, right? So, either you stop buying it on the open market and you just consume the one you produce at home. But if that component, the tiny portion you keep on importing, that will go up in price. So I would say maybe you would be less impacted if you are in the US, but still, it's not like you're gonna be completely immune from what's gonna happen. And again, if you are in the US, just look at heating oil, which was skyrocketing. Not to mention nat gas, which skyrocketed, well, because of the glacial storm or whatever, 2-3 weeks back. But I think it came back down a little bit, but still, it's a bit higher than what it was at the beginning of the year. So probably, a tiny impact from the energy side, it's going to be felt in the US as well. My point is that probably not as much as in other parts of the world, right? But it doesn't mean that you could just shrug it out and saying, well, not my concern, right? Look, these are a few events that we had, and what you see is basically how the S&P behaved and how crude oil behaved in previous events in the Middle East. So you got in purple the Gulf War, in orange the Iraq War, and most recently in green when the US bombed nuclear facilities last year in June. So as you can see, throughout the Iraqi war, oil kept on going higher, but at the same time, the S&P went higher again. Throughout the Gulf War, oil spiked initially, and then it came back down, and it basically stayed range bound, all things considered, right? And with the bombing of nuclear facilities in Iran recently, what you see is that oil spiked, and then it came back down. But instead, you're seeing green stock market kept on going higher, and even throughout the Gulf War, the stock market kept on going higher. So again, is it a massive problem for the stock market? We're going to talk about that later on, but, a little bit of a spoiler. I would say, think about what's impacting valuations for the stock market. Is it, a war in Iran? Is it impacting revenues, earnings projections, earnings growth, and whatnot? If yes, then okay, you should be worried. If not, then maybe you shouldn't. So I think, over a long enough period of time, that's what would drive stocks higher or lower. In the short term, sure, volatility all across the globe because, again, knee-jerk reactions, liquidity issues, cascade of events, right? Maybe, look, stocks could be fine, but again, if everyone in the world and their mothers are selling whatever they got to acquire the dollars to buy the oil, I sold my treasuries, I sold my gold, I sold my silver. What do I have left to sell in order to get the dollars to buy the oil? Well, I got this stock portfolio. I want to sell it all. Don't care. But look, the fundamentals are spectacular. Sell it all and need the dollars. Fuck the fundamentals of stocks, right? Again, so it could be caught up in the crossfires, right? So we'll see about that. Now, look, as for the price of oil, and again, this is not a prediction, but just for reference and to have a little bit of perspective, this is basically oil price and how it behaved throughout what we got in the past. So crisis in the Middle East. And as you can see, you got the oil embargo, you got the Iranian revolutions, that was the Gulf War, when Iraq invades Kuwait. Okay. USS Cole bombing. I didn't remember that. And then what? Revolution in Libya, the Brexit, the trade war with China. So again, this doesn't have to be a predictive tool, but before it's just tame down your fears, so to speak, and try to be objective about what may happen, right? And again, for intellectual honesty, we don't know what type of time frame this is, right? Let's say if it is a monthly or a quarterly chart, you are looking at the closes. So, for instance, in here, Russia-Ukraine war, they show you that oil went down, but they don't show you how long it stayed up, or if beside the simple closes, in the inner room, it spiked one way or the other. So it's more of a long-term type of thing, but just to give you a little bit of a context, right? And then what we got is oil prices compared to inflation. So as you can see, obviously they are pretty tied up together, right? So, if you are worried over inflation because, you would like to see more rate cuts in order to see stocks propelled higher, or, more rate cuts so that if you got bonds, they will be appreciating in price. If you are worried about what the Fed may do, I think this is a good comparison in between what could happen. And again, look, every single time that we had a spike, right, in crude oil, like in here, right, sure, initially you got a spike in inflation too, and then comes back down. And inflation ends up lower than where it was before the spike, right? Let's find out another example. This one, 2008, spikes up, inflation obviously spikes up, then oil crashes back down and inflation goes into deflation actually, right? Okay. This one right here, what was that? 2020, so the COVID pandemic, right? Ahead of that, you see that inflation was here essentially between 2015, 2018, 19. You had your oil going up, inflation coming up a little bit, and then oil collapses in the crisis, and inflation goes down below the levels it was before the spike. Did it happen the same in here, right? Not really, but, kind of the same dynamic. Oil spikes after the stimulus, and then the Russia-Ukraine war, inflation follows, and then oil comes back down and inflation goes pretty much where it was pre-pandemic. Same levels, same range. So, have a little bit of perspective when you look at these things, especially if you want to assess what may happen over a long enough period of time. That would be my take on it, all right? Of course, my phone is going ahead. Yeah, sure. Should just mute it, right? Now, let's have a look instead at Bitcoin, which, surprisingly enough, when everyone is selling whatever they got, Bitcoin kinda called me a liar, right? Last week when I was looking at that, it was basically in here, it was going down. This candle was still bearish. It looks like, just in that very day, it completely reabsorbed, and then it kept on pushing higher. Monday and then Wednesday, and now we pulled back once again. So, for now, I would say let's have a look. It's not really one level, might be just some sort of a block like that. So let's have a look at what happened around this base right in here, right? Can we bounce and keep on being bullish, right? Or, at the end of the day, if you look back at a few levels we were looking at before, we stopped right in here on a closing base. What level is that? It's a level which we are dragging ahead from here. The previous highs in 2024, in October. As you can see, we kind of bounce around them. We break them. We try to retest the area. We are rejected. Come make new lows. We keep on, pushing back into the same area, and we find out another sharp rejection there. So again, the point now, I think this might be a very good decision point for Bitcoin. Like if you think about this area, pretty much right in here, right? And of course now in here, I mean, you really want to see it being resilient at this point and keep pushing into this area. Now, again, was I expecting it? Well, when the world goes massively risk-off, no, I wasn't expecting that, to be quite honest. Does it change a lot in the grand scheme of things? Well, I mean, still kind of the same range, right? The range was, you have the down move in here. So that's now your range low. And this is your range high, right? Because you have the pullback after the drop. You have the pullback, right? And this is basically where you have been. So that's your new dealing range right here. So does it change a lot in the grand scheme of things? Well, no, we are basically in the middle of the range, as you can see in here, right? So doesn't really change a lot up until the point we break one way or the other. I would just say it might be a good decision point in here. If we can start to trade at a premium, considering this dealing range, aka which would mean above the threshold, the midpoint of it, right? Because every time we try to come above the midpoint, which would be right in here where we are at right now, we always, being rejected lower, like 2-3 days lower, not even 1 day lower. Now we are above it, so if we can hold this midpoint and start to build up, that could be cool. Otherwise, again, if we now immediately break this base freshly built up and we start to push lower, well, at that point it becomes bearish once again. I think again, although charts don't lie. If price going up, price is always right? For me, it is just strange to see that the most risky asset, or the most risky asset class, so to speak, it's trying to push in these circumstances. Could it be, it is just another rotation? Maybe. I would encourage people to not jump on the bandwagon of, well, you see, once again, the world is cracking up and it's being dismantled, and people are finally waking up to the realization that they need to hold Bitcoin because it's completely decorrelated, decoupled from the banking system, the political system, the geopolitical system. Sure, maybe. Point being, even if you hold a lot of Bitcoin, if energy cost goes up, right, and you need to pay for it in dollars, what are you going to do with your Bitcoins? You will need to sell the Bitcoins too in order to acquire the dollars to buy the energy. So I think, all things considered, I still see it under pressure up until the point, again, we managed to break out of this range, right? So up until that point, still in a consolidation overall, ranging environment. It's just better than what it could have been, all right? So that's a positive, I guess, but doesn't really change a lot for me. Like if you zoom out on a weekly time frame, look, what are we doing now? Sure, it might end up as last week when it was looking particularly weak on a Saturday morning, and then it pumped into Sunday. Right, yeah, that could absolutely happen, especially up until the point we are above this base, which was freshly built up. I'm just saying, I don't see a fundamental case yet. But again, at the end of the day, I will always submit to price. If price can show that we can hold this level now and keep on bouncing, price is always right. I'm just a bit skeptical, right? That's it. But for now, up until the point we can hold, everything is on the table. Both, keep on staying range bound, trying to push higher. Again, up until the point we don't break, I would say I would be neutral more than anything else, right? So that would be it for what we were looking at. And, I know it's difficult, but I did my best to try to link up all together what we've seen in oil, currencies, yields, gold, other precious metals, and, to some degree, Bitcoin, all right? Hope it was helpful. And now let's transition into what? Into the stock market as usual. Now, the stock market is another one, in my view, which looks just better of what it may really be, right? And, look, it's not plunging, right? But at the same time, I don't think it's screaming, I'm the picture of health and fitness, right? Like, look, we started out the week, initial drop, and then we pumped back up, all right? And that was Monday. Then Tuesday, all the way down, and we made new lows. I mean, on this time frame, but we're going to look at the bigger picture later on. So we make new lows for the week, which, just freshly opened. Then again, what's going to happen? Sure, we pump all the way back up, right? Toward what? Well, Monday's highs, essentially. And actually, in this case, the S&P cannot make new highs above these Monday's highs. The NASDAQ actually did, I think. Yeah, it did, right? So again, NASDAQ a bit stronger compared to the S&P, but nonetheless, all of them followed the same path. Again, another mean reversion. We try to push into these highs, but no, we are rejected and we come back down lower. And, on a Thursday, then on a Friday, look, we try to push higher. European session comes off, down we go. And, the rest of the session in the US was a little bit of a rebound and then back down again. And we closed at the lows. That's the important thing, I guess. That's, after a huge sell-off on a Friday, on the back of bad NFPs and all the rest, we closed very near the lows of the session. Now, if you zoom out, what you see is that, it looks like, again, if you just look at the S&P, right, as we were pointing out, it looks more and more like around the top, right, around the redistribution process at these levels. And sure, we got this huge area, which was previous support in the past. So, maybe we need to tap back into it, hoping that it holds, right? But it's hard to find immediate strength in these markets for now. And if you look at the NASDAQ, well, the NASDAQ has been even weaker. If you remember, while the S&P, all things considered, it was keep on making new highs. The NASDAQ wasn't really able to, right? As you can see in here. So, it's hard to think about a very strong equity market when the main drivers to the upside, aka mega caps, big tech companies, they are not participating a lot in the rallies, right? And we have been talking about AI narrative, AI bubble burst, and recently we have been discussing software is dead, right? Because AI is going to replace software companies. So, there are a lot of narratives which are putting a bit of pressure on the stock market. One of the most recent ones, again, we have been discussing that a tiny bit. It's the private credit with, Blue Owl. And then what we got, I think it was yesterday, BlackRock denied withdrawal from a good enough fund in private credit. So, speaking of which, I think credit spreads are doing what? They keep on creeping higher, tiny notch, but is it a massive problem? I would say so far, again, no, at least not overall, but, a few chunks, a few sectors of the private credit market in general, mostly private credit, are under a huge stress now. And the problem is that you don't know what you own. You have been promised, well, we are rock solid. This portfolio is rock solid. Well, we can market this shit to market at 99 cents on the dollar. It's just that when you really have to market it to market, you are able to get out of that for 25, 30 cents on the dollar. Or you just prevent people from, making more redemptions because you don't have the liquidity. Or, if you will allow all the redemptions you're asking for, well, the fund would plunge. So, it's a very precarious situation in those funds. Luckily, again, they are not an expression of the vast majority of the credit market. I'm still thinking corporate credit. If you're thinking about corporate bonds, like those issued by, I don't know, Google or, someone like that, they're still fine. I don't see a huge risk there for now. But all these, private credit, venture capitalists, this BCD, right? Or BDC, I don't remember the acronym now. It's kind of like what I was talking about with SPACs, right? Special purchase acquisition, those fucking shit where you put money in, we don't know where to invest them, but we are going to find someone to invest them in. It's just that we don't know. But in the meantime, just give us the money you got. Sure, fuck off. All right. But, it's the credit cycle at the end of the day. People stop asking questions just to realize that they put money without assessing the risk whatsoever, right? So, look, I would say, all things considered, the stock market still going sideways. Now, look, there are all the risks. I absolutely agree with that. And, we may get to a point where we have a tiny correction. Now, for instance, SPY already came back down from the top, what? Almost 4%, 3.70, right? The Qs came down from the top, what? Maybe a bit more, let's see. Yeah, 6%, but, they are a bit more volatile historically. If you start to zoom out like these, is it a massive problem in the sense like, maybe you start to see a topping process, sure, but what type of a top you would expect? Is it a kind of top where you basically come back down in here? Or, all things considered, we are around the 200 days moving average. We are still living above it. We might try to break it and breach it and living below it for maybe a week or two. And it's going to end up to be the usual 6, 7, 8, 10% correction that you have historically every single year. And that's it, right? I think that's the important question to ask. Plus, if you see a correction, at the end of the day, it's going to end up to be a correction, right? What do? You bail out on everything, you sell whatever you got and you go into cash? Or is it a good opportunity to actually buy stuff on the cheap? I think that's what you really need to assess. I don't honestly have an opinion because I think, again, a lot would be driven by liquidity. So for now, I would say I don't see a systemic risk, right? When it comes down to credit, liquidity, and all the rest. I see a few risks which could very quickly, if they escalate, like very, very quickly, cause problems on the liquidity side as well. But, you can only take decisions based on the information that you got now. So for now, I would say even if we keep on dropping, I would be a buyer of whatever correction we see. For now, all right? But always have your levels, manage your risk, and try to be nimble, stay in the loop, and watch out for the risk. Because, again, there are many. But that's just part of the game at the end of the day. So I think, again, look, if we want to check the stock market, like, seasonality-wise, this is what the seasonal pattern would suggest. So obviously you have your past 20 years, 10 years, and since the 50s, and they all should suggest that, well, at the end of the day, March, it's kind of a good month. Yeah, if not that we are in a midterm election year. So, that's the only risk you could see. Like, March might end up being good, but overall, Q2, the more you approach midterm, It might be that at the end of the day, yeah, March might be positive, but then April, May, getting into the summer, if you look at the black lines, right, it might be where things really start to fall off a bit. But then after midterms, right, when things are clear, we got the elections out of the way and behind us, and the market will look through it, and we have a positive trend in the Q4, right? I think a lot of that will depend on what happens at midterm. And I would say, it might sound strange, but I'll think, let's say Trump loses these elections and the Congress gets split. I think the market will like it in the sense that nothing is going to happen because it's going to be impossible to pass any legislation. Well, I mean, the market won't have to readjust for anything, won't have to assess any new type of policy risk because there won't be a new policy. It's going to be impossible to pass it. So it's going to say, well, I mean, it's all good. We don't have that thing in our way. So as long as the rest, aka liquidity conditions and characteristics, as long as that remains solid, we can keep on pushing higher. So, that could be one way you're looking at it. Because instead, I mean, we had something big going on into the elections, and therefore new policies will be implemented. We need to look through them and to assess the risk. So maybe it's a bit early to keep on buying like there is no tomorrow, and the market will keep on being stagnant for a little while longer. So, that's how I see it somehow. Another one still, seasonality. And as you can see, March, it's, more often than not, it's positive. Sure, this is just stats. There can always be an outlier. Why not? But, it's just a frame of reference, right? Then what? A bit more of behavior as for the stock market when we got military events. Want to take a screenshot. It looks like, again, the vast majority, they were short-term volatility episodes, and then all of a sudden, the market looked through them, and, after a while, it put its shits together and it keep on drifting where it was already drifting to, right? Maybe, again, this one might be even better if you want. I think a lot of what may come out of this, as for the stock market, it doesn't really depend on the war, right? The war, I think the war itself, it's not a good driver for stocks. Again, as I was anticipating, does this war have the ability to creep out, I don't know, the ability of Nvidia, Google, Microsoft, Tesla to keep on growing revenues? Yes? Okay, then you should sell the stocks. Do you think that just because there is a war going on in Iran, Nvidia won't sell more, GPUs or whatever? Or do you think that, the other tech giants will stop building up AI? That may be the thing, right? Now, sure, if you think, well, sure, but if there is a war in Iran, oil spikes and consumers stop buying whatever, maybe the tech sector will keep on building up the shit they're building up, but the rest of the economy, us peasants, we're going to be hit very, very hugely. So we will need to pull back, hunker down, stop spending, start saving a lot, moving all our discretionary spending into primary needs. Sure, in that case, yeah, revenues will be impacted for a lot of different sectors and a lot of different stocks. And then you need to ask yourself, are those stocks the major drivers, if you think about market capitalization for the S&P? Yes? No? So again, you see that you need to factor in a lot of stuff. Like in this case, what we've seen right now, it's the market's not really going anywhere on a larger enough time scale, right? And why is that? Although again, software has been hit, Mag 7, they have been hit, right? Financial sector has been hit, but the counter to it is staples, utilities, real estate, energy sector. They're all shooting higher. at the end of the day, the market cannot really rally if you don't have the very hugely weighted, from a market cap standpoint, participants joining into the race. But at the same time, it's not really tanking, because although these very huge drivers are not performing well, the rest of the market, it's still resilient a lot, and it's kind of countering that effect. So again, this is what you should ask yourself. Which sector would be impacted? What's their impact on the aggregate benchmark? Right? So again, I'll think again, as I said at the end of 2025, this is not really the best market ever for, set and forget investors. Buy and forget. Buy and look back at it in 2 years. This is more a market for traders. There are a lot of rotations, and I'm not saying you shouldn't put money in for the long term, just saying be aware and be ready to stomach the volatility. All right. It looks like the retailers actually, they kept on being aggressive in these markets. And they they are still pushing, right? Now, the fact that they're using a lot of options, to some degree, it's a double-edged sword, right? Options can be good up until the point the market goes where you think it's going to go, but there will be a point, and sadly, options start to fail for the retail traders just at the worst possible time, which means when you have a downturn, right? But again, it's like leverage. Options are another way to add leverage to the system. And up until the point, it's like margin debt, right? Up until the point the market goes up, that's fuel for the market to keep on being high, or at least being resilient. And it works until it doesn't. And when it stops working, usually it does it in a very dramatic fashion. So, pay attention if you're playing with options, all right? Then what? It looks like the ATF volumes, they went up like a lot in February. So, again, looks like the retail investor, it's keeping on piling in stocks, and they are buying every single dip they can. So again, they are kind of putting a floor, right, underneath the market for now. Again, doesn't necessarily mean it's going to last forever, but for now, it looks like somehow they're finding new money, new liquidity. And again, we have been looking at margin debt skyrocketing. So again, what's the positive thing? Well, there is still someone which is willing to lend them money to buy the stocks, and they're willing to take the risk, to take the loan to buy the stocks because they believe in it. But at the same time, the risk is, well, what happens if the market really breaks? That unwind of leverage could be pretty violent, right? And then finally, look at that. This is basically the put delta positioning. So which means, if I'm reading it correctly, that there is a huge amount of put exposure into the market. I think, look, and again, we don't need to get into the discussion about what type of environment we do have in the options market. Also because it's not really my bread and butter, but I just keep an eye out for what type of environment are we in. Are we in positive gamma or negative gamma, whatever, just for the sake of it? Because depending on the environment, the dealers, which are the ones which are selling you the options when you want to buy it, they will need to hedge themselves by what? Chasing the market or countering the market. So, it might play a role in that. But look, keeping it very simple, what you can say is, if there are a lot of people which are already hedged because they already bought the puts, so downside protection, that may signal that not a lot of people would need to sell the actual assets because they already have the put to protect their portfolio from a potential downturn. Now, sure, here they don't tell you if, those puts are expiring in 1 week, a month, 3 months, whatever you. But, it is just an approximation at the end of the day when it comes down to the logic that you can extract from it, right? Another good thing might be, look, if everyone which wanted to express a bearish view on the market, which again, you could do it by selling the actual asset or buying the put, which is basically a bet on the downside outcome. If everyone which was already willing to sell already expressed that willingness by buying a put, who's left to sell? And most importantly, if you have a rebound in the market, what's going to happen? A lot of those puts are going to be worthless. What do you do then? You sell your put. But if it is true, look, think about it. When you buy a put, right, what's going to happen? You buy a put and you bought insurance, so downside protection, right? Look at the other side of the balance sheet. The dealer, which is selling you the put, is exposing himself, right, at an infinite risk that he would have to pay you, right, in case the market goes down. So what does the dealer do in order to hedge himself and being kind of delta neutral and just being free to collect his premium, right, and forget about it? Well, he's going to be short the underlying. So if you buy a put on the S&P, the dealer sells you the put, right? He promises you to pay whatever the options is going to be worth if the market really tanks. So he got an infinite risk because the market could tank like who knows how, right? And how much, right? And, he collects some sort of a premium, a spread, whatever you want to call it. It is a premium, right? Now, in order to not be in fact, if the market really tanks, what he's going to do, he's going to short the market so that if the market goes up, he collected his premium and he's fine, he's hedged. If the market goes down, yeah, he collected his premium, but now he has to pay you a lot. But those money that he's going to pay you are going to come from his short positions. You see how it works? The dealer needs to be hedged and delta neutral the most he can at every single time. Otherwise, he's going to go out of business. The good thing for that would be that the same as when you buy the put, he's going to short the market, basically net. When you when you sell the put, because you don't want it anymore, you don't think you need protection anymore, or you think that put, it's going to be expiring worthless. When you sell your put, the dealer doesn't need his hedge anymore. So he closes his short. What happens when you close a short? You buy. So you generate buying pressure. So that could be, not today, maybe not tomorrow, but that could be a positive factor for the market at the very end of the day. And again, I think there is not really a lot more to say. The market, it's most likely weak at this point. I don't think this is the picture of a health and fitness. It's just very nervous. It's just very rangy. At least that's how it has been so far. I'm still thinking, the more I look at it, the more I would think a correction is possible and we might see one. I'm not sure if it's going to come in March or April, but, I think to many different levels, we are due for a correction. Again, a correction doesn't mean that we are going to drop 30, 40%. But again, would it be so incredible to drop 7, 8% from the highs? I mean, even 10% on the back of some news event or some catalyst or some fear, some war, some panic coming out of whatever these days? I don't think so. And then when we got that, we will look at what the fundamentals are, we will look at what the conditions are, and we will try to establish, okay, that's the correction we were fearing. Is it over yet? How much damage was made? Are we sure? Is it safe to buy now? But we will talk about it when we get there, right? For now, I would just say the managing risk, it's the best course of action. So, again, all throughout this range, we've always saying, if you have positions which are particularly in profit, well, trim them down. It's another way to manage risk, right? And if you have positions which throughout all this very good performance overall of the market, they already struggled and they are now underwater. Well, I mean, if they were weak while the market was going up, why would you expect them to be strong while the market is starting maybe to correct? So manage your risk, trim down those positions as well, right? So again, that would be it for the stock market and for the rest of the video, I guess. So I'm wishing you a very good rest of your weekend. Hope you are gonna have fun. Please try to not overreact to what's coming on out of the Middle East. And again, always try to look through it. Why something should happen, why something it is happening, why something would not happen counter to the common narrative. Is it just people selling fear, or is there a fundamental reason for A happening over B, right? Just try to be nimble and just try to not knee-jerk react, right? As usual, be nice and be cool, and we're gonna get back to it next week. Knees out.
Let me tell you something, Mr. Sullivan. Do you care to know why I'm in this chair with you all? I mean, why I earn the big bucks?
Yes.
I'm here for one reason and one reason alone. I'm here to guess what the music might do a week, a month, a year from now. That's it. Nothing more. And standing here tonight, I'm afraid that I don't hear a thing. Just silence.